Welcome to OCBC Mid-Year Interest Rates Outlook. The first half of the year was dominated by tariff headlines, trade policies, and their implications on growth and inflation. The notion of diversification away from US dollar assets has also gained some traction. Some of these themes may be extended into the months or even quarters ahead. Let's start from the US interest rates outlook. In terms of Fed policy, we continue to see the room for the Fed to deliver up to 3 interest rate cuts this year. This base case represents a no recession scenario. Triggers for interest rate cuts will likely need to come from the US labor market, i.e. the growth front. Continued cooling in the labor market will justify US interest rates at less restrictive levels, as long as there is no strong rebound in inflation. Hence, inflation is indeed the key. Inflation impact of tariff is yet to show up in the data, and precisely because of this, the Fed prefers to be patient, waiting for more confirmation. Should inflation impact be big, there might be further delays in Fed funds rate cuts, but the direction for the Fed funds rates to go lower appears to be clearer than the timing itself. Despite a divided FOMC, most officials assess that some reduction in the Fed funds rate this year would likely be appropriate. Market is pricing in roughly 225 basis point Fed funds rate cuts for this year. US Treasury yields have rebounded from the lows seen in late June, as US payroll and labor market statistics printed stronger than expected, while continued tariff threats add to inflation risk. We have a mild downward bias to US Treasury yields on a multi-month horizon. Market is not overly dovish in rate cut pricing. As and when rate cuts materialize, the lower level of front-end interest rates will still be factored more into the valuation of short-end bonds. At the longer end, US fiscal position remains a concern for foreign investors, likely leading to continued gradual diversification away from US dollar assets. But for domestic investors back in the US Treasuries are local currency assets and remain as safe havens. We expect US Treasuries to garner some support from domestic demand, from a subdued growth outlook, from the recent regulatory easing, and from the slower quantitative tightening pace. The US Treasury bond supply outlook is stable in the coming months, but granted, fiscal concerns remain as the medium-term risk factor. There has been some degree of decoupling between Asian interest rates and US interest rate performances during the first half of the year. Asian local currency government bonds outperformed, which was likely due to domestic factors in Asia, diversion of flows away from US dollar assets, while US dollar rates themselves were driven by idiosyncratic factors back in the US. Speaking of diversification, potential candidates that may benefit from diverted flows include the euro, and within Asia, we see Sing dollar assets, Chinese yuan assets, Korean won assets, and Malaysian ringgit assets as viable investment alternatives for investors. Sing dollar interest rates outperformed US dollar interest rates by a wide margin so far this year. Singapore government bonds stand out to benefit from safe haven and diversification flows. Singapore is AAA rated. The government operates a balanced budget policy, and most of the government's borrowings are not used to fund its expenditure, which allows flexibility in the calibration of auction sizes in reaction to prevailing market conditions. Meanwhile, Sing dollar liquidity has been flush, and Sing dollar interest rates have moved onto lower ranges. Before higher supply of bills that mop up liquidity, short-end Sing dollar rates may be kept at 1.8 to 2% level. That said, we note that front-end Sing dollar interest rates have been very volatile. SORA, the overnight rate itself, fluctuated in the range of 1.43% to 1.7% in the first half of July alone. Sing dollar interest rates may have found an interim floor at around the 1.5% level. While Asian interest rate markets have seen some decoupling from US dollar interest rates market, we caution against being too complacent. Tariff or trade policies and geopolitics are key swing factors to the disinflation progress in developed markets and to the growth outlook for many economies, which in turn will have implications on central bank policies and bond performances. We continue to monitor the economic fundamentals, tariff policies, the liquidity conditions, and bond supply outlook and investor demand to assess the interest rates outlook.